If your kid inherits an IRA in North Carolina, they have 10 years to drain it. And the tax bracket that hits may not actually be in their own control. Currently, the inheritance of a retirement account is governed by federal law called the Secure Act, which passed at the very end of 2019 and has been effective since January 1 of 2020 for all retirement plans, whether it's a 401k, traditional IRA, or Roth, or something similar. Before the Secure Act, the beneficiary who inherited a retirement account could stretch the benefit of that account over the rest of their lives, taking small required distributions based on their own life expectancy until they died. This was very commonly called the stretch IRA, which often created something similar to a pension for the children of the plan participant. Since the Secure Act was passed, most beneficiaries who aren't a spouse have just 10 years to take the entire balance of their share of the plan after you've passed away. And every dollar that comes out of that plan to the beneficiary is taxed as ordinary income. If you have a retirement account that's worth over $500,000 and haven't reviewed the beneficiary designations or really assessed the tax consequence to your beneficiaries, it's time to have the conversation. Click the link below. Let's look at how the tax landscape has shifted since the Secure Act's passing. Prior to the Secure Act, inheriting an IRA meant stretching it over the rest of the beneficiary's lifetime. Now we have compressed withdrawal windows, meaning your beneficiary has only 10 years to take the entire balance. Every dollar that comes out of that plan is ordinary income on top of their existing sources of income, like salary, bonuses, or business profit. If you leave behind a $1.2 million IRA to, say, 3 kids, they each get $400,000 apiece. And if they're responsible or at least tax aware, and even the least bit, they may break that up evenly. That means $40,000 a year for 10 years, all things considered. That's an additional $180,000 to $220,000 in taxes that they will pay from that $400,000. Far more than they probably would have paid under the post or pre-Secure Act regime. Now, that doesn't sound awesome, but it could be worse because how your beneficiary receives or withdraws those assets can really change the tax rate and the amount of tax that's paid by them. Now, there are some beneficiaries who don't fall under the 10-year rule. They have a life expectancy stretch either permanently or for a period of time. These are called eligible designated beneficiaries, and the most common is the surviving spouse of the plan participant. The surviving spouse can either roll the 401k or IRA into their own 401k, their own IRA, treating it as if it's theirs, or they can elect to stretch the inherited IRA over the rest of their lifetime, their life expectancy as defined by the IRS's actuary tables. The minor children of the plan participant, and this is only the children of the plan participant, not grandchildren. So if you are old enough that all of your children are adults, this one doesn't apply to you. But minor children of the plan participant, while they are a minor, then things switch over to the 10-year rule for them as well. Likewise, beneficiaries who have a disability, they qualify for a life expectancy stretch over the rest of their life. Those who are chronically ill, as defined by Treasury regulations, or a beneficiary who is less than 10 years younger than the plan participant. This is often siblings, step-siblings, life partners. Now, when can naming a trust on your IRA designation be better than naming the child outright in terms of taxes and the Secure Act? Well, a trust is going to be able to force this 10-year distribution window, the full length of it, and nothing less than that. Meaning the trustee can force it be distributed in the most tax-efficient way possible, as opposed to allowing a beneficiary to take it sooner than 10 years, which could subject it to a higher rate of income taxation. However, the trust needs to be able to distribute the income out to the beneficiary. If a trust withholds and converts income to principal inside the trust, it will subject the IRA distributions to a higher rate of taxation, the trust's rate of taxation, which will subject it to about 37% tax for every dollar over $15,000. So we definitely want the appropriately drafted and administered trust to receive and distribute IRA proceeds, not one we find and print online. If you haven't established a trust or you've got an outdated plan, clicking the link below is the next step in the process. Now, all of this is just numbers and rules, and the next question is, how does it apply to you? Well, working with a North Carolina tax specialist, somebody who strategizes what future income taxation could look like, is going to be really helpful for you to actually have meaningful insight as to what your beneficiaries will receive and what types of planning would be appropriate to make it as tax efficient as possible. While the 10-year rule creates some guardrails, we can get more intentional as to how distributions are made, when they're received by beneficiaries, to try to time low-income years, like if they're on sabbatical or medical leave, or if they're planning an early retirement. Good tax strategists are going to model these realities to allow you to more intentionally leave your IRA behind. It could be that you don't split it evenly between all of your kids because one is higher income and another is lower income. That, of course, depends on how much you care about the net amount versus the gross amount in taxes in general. The Secure Act rewrote the math on inherited retirement accounts. Every North Carolina family with a retirement account at or over $500,000 in value should be having this conversation with an experienced estate planning attorney and a tax strategist. Link below to start that. Our next video is on transfer on death accounts, payable on death accounts, and beneficiary designations on our financial accounts, and what's the difference? Protecting your family requires more than just standard documents. Schedule your consultation with our team today.